Do you fear any kind of a spillover or contagion risk from what's happening there to hit the U.S. bond and or stock or debt markets?
Well, Brian, it's hard to predict policy errors, especially catastrophic ones. Um, I'm not fearful that we're going to have a carryover. We did look at the immediate impact and the secondary and even tertiary. We've all learned that after '08. You know, when people use leverage, it cuts both ways. And these liability-driven investments that they used were leveraged bonds. And so when that market moved so rapidly, and as well as the deadline, it did cause some forced sales. And when you got to come up with collateral right away, liquidity just disappears. So it wasn't just the first-hand effect, but the second-hand. We think the banks will weather this. They're in much better shape than they were before. And I don't think it's going to carry over into the USA or other locations. Now, that said, you just never know in this environment. What other shoe is going to drop?
I'm going to get to that shoe in just a second, but I want to go back to your answer. Do you think there was a catastrophic policy mistake here?
Well, a very significant one. Maybe not catastrophic, but you know, anytime that the government has to do an absolute U-turn the next day, and I guess they didn't want to use that phrase. Liability-driven investing is fine, and it works, except when you have rapidly rising interest rates and then your currency falls apart. And those two things happened within a 2-day period because of comments from the central bank and comments from the government. So, you know, policymakers created a firestorm that really hit the UK pensions, and therefore causes them, anytime you have to raise liquidity fast, then prices are going to suffer all around the place. And it's hard to sell private assets. It's hard to raise money when you suddenly have to.
You know, we go back to the contagion risk. And again, I haven't had anybody like yourself that has said, yeah, it's a definite contagion. Likely no, but we just don't know what's sort of under the hood. And we go back to these acronyms from 2008, CLOs, CDOs, collateralized loan obligations. I saw a story on Wednesday, Chris, that some of the CLOs in London were getting hit because they have these requirements about how much can be certain types of debt. And when things get downgraded, things have to be forcibly sold. Isn't that the kind of potential black swan that nobody really thinks about, which is we don't know what people hold and we don't know what they're not allowed to hold. And if we see a lot of debt rating downgrades, either there, Europe, or maybe here, there seems like there's some, maybe tiny, but some trigger risk, I would imagine. It's not zero.
It's not zero, Brian, but I think the risk of an '08 is literally down in the 4%, 5% range. It's a very low likelihood. Remember, '08 was a 1 in 70-year event, not a 1 in 100, but probably a 1 in a 70-year event. That doesn't mean it can't happen again, but I think they put safeguards in place. Anytime in history you have rapidly rising interest rates, and let's remember the U.S. Fed's raising by 3/4 of a point. That's huge. Historically, we were always 1/4 and a half was big. Now you've had multiple 3/4 point rises where the level of rates are up to 4%. It's going to squeeze any kind of leverage. Anybody that borrowed short is now squeezed on that. And whenever you have to raise collateral quickly, then you get distressed pricing, and that lowers the value of everything. So I think the banks have passed the stress test. Those are important regulations put in to keep U.S. and European banks in a better shape.
Yeah.
Doesn't mean we might not have trouble, but I think we're in for a long, tough recession. I don't know if I agree with Jamie Dimon in another 20% drop, but 10% from here in the U.S., because I think earnings are going to come down, and we're seeing that starting this week.
You think the market is still, even though multiples have come down a little bit, the E and PE has come down. You expect it sounds like to go down even more, which means it sounds like you think that multiples need to come down more.
Well, in terms of the S&P 500, Brian, I think there is a risk that we could test the lows of 3,250. We may bounce, and we've held 3,500, so we'll see. But we've got 3 weeks of earnings coming, so that's a long reporting period. And the forward outlook of the CEOs is going to be important. because they've actually been a lot more negative than the market.
Yeah, and we're going to wait and see. Obviously, I don't think I've ever heard you, Chris, in our 15 years of interviewing together, say that you think we could fall another 10%. Scary stuff there. Very quickly, before we let you go, you guys have been leaders and sort of pioneers in many ways in ESG investing. Lately, there's been kind of this ESG backlash. This treasurer of South Carolina is pulling money from BlackRock. What do you make of this sort of almost partisan fight when it comes to pension funds on this topic?
Yeah, it's disheartening, Brian, to me, because I view that E, S, and G, while the initials have certainly become political fire, they're really just long-term business risks, and it's focusing in. As a long-term investor, I want companies to make money over 10 to 20 to 30 years, not just over the next 90 days. And I think these are people, natural reactions to what's going to be a huge change in the next 20 years is we really have to dramatically change our energy resources and how we get energy. And that means there'll be some winners and losers. And unfortunately, in this environment in the USA, you see extreme rhetoric. I think smarter people will look at this from a long-term perspective and recognize this is a mega trend that's going to take place. You're going to have stronger storms, more aberrant weather, as well as the need to change our energy resources over the next 20 years. So it's not just overnight, and it's not just a change, but I'm sorry that it's getting caught up in a political fight. Pensions are trust funds, and you attack them from a fiduciary standpoint of investing for the long term and paying attention to risk.